Hey, what's going on everyone? It's Griffin here and I hope you're all having a great day. Now, in one of my previous videos, I asked the audience whether or not you'd like to see a piece of content going over some of the elements that I look for when assessing when I want to sell a stock. And that can be selling off at a nice profit, or it could also mean cutting your losses if that position did not perform up to par with what you were anticipating for it. At the end of the day, the whole goal of my channel is to help you better understand and master your personal finances as well as stock market portfolio and other investments. So hopefully you take out of my content various different elements that I look for in stock analyses, as well as larger market trends that I look for when I'm looking to make some new investments. But yeah, so selling off one of your positions for a nice profit is very different from cutting your losses on a position that has not performed up to par with what you were expecting. So in today's video, I wanted to give you some various different pointers and elements that I personally look for in each one of these scenarios. And if you're new to investing, well, as always, I'd highly recommend that you check out the links down in the description where you can open up a Questrade account or a Wealthsimple trade account and get some free money for doing so, along with some other resources that I use and recommend. All right, so let's first start off with selling off a winning position and materializing some gains. Now, let's first remember here that just like with unrealized losses, well, unrealized gains can theoretically also be wiped out if you never end up selling the position and the stock ends up taking a turn for the worst at some point in your holding period. So this is arguably just as important in terms of the time at when you're selling as when you're first getting into the position or dollar cost averaging, because this is going to have a direct impact on your return on investment. Typically though, I only open up a position in an individual stock or ETF that I see performing well in the mid to longer term after conducting proper research into the individual company and broader industry that it operates in. This is something that I speak about quite a bit on the channel, so you're most likely familiar with this concept. But over time, as you hold a stock or ETF, especially over the past year or so, where companies operating in industries like tech saw a massive boom, the typical narrative of 8% annual growth was blown out of the water, even just with the S&P 500, for example, having grown by nearly 50% in the past year. And this does bring a lot of companies into what we might consider expensive territory from a price to earnings standpoint. So even though the right moment to materialize profits on a company will greatly differ from investor to investor, well, here are a couple elements that I factor into my decision. The first element pertains to the average investment horizon that investors have for a given stock. And here's what I mean by this. When a large portion of the investors and institutions that are holding stock in a given company shrinks down dramatically from, say, a 3, 5, maybe even 10-year average investment horizon, quickly down to a time frame that might be a month, a week, or maybe even a day. Well, this is indicative of a euphoric environment around this given position that I personally become uncomfortable with, and it tells me that we're entering a period where this stock is being overpurchased. And while this is a concept that I already had my own iteration of, it's explained really clearly in this book right here called The Psychology of Money by Morgan Housel. And I'd like to read a passage from it speaking about this shortened time frame that investors have. So it says here, an iron rule of finance is that money chases returns to the greatest extent that it can. Bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to mostly short-term. And I'm paraphrasing a little bit here and skipping some sections, but it continues on and says, bubbles aren't so much about valuations rising, that's just a symptom of something else. Time horizons shrinking as more short-term traders enter the playing field. I definitely think that that's a really interesting and well thought out way of putting this euphoric market environment. As a quick example here, Mind Medicine, ticker symbol MMED. This is a stock that I spoke about around 6 months ago when it was trading for around $1 a share. I really thought that this industry as well as the company was very interesting, but it quickly went up around 500-600% in market value because a lot of investors were pouring into this company with the anticipation of making a high return in a very short time frame. What ended up resulting? Well, the stock shot up in value dramatically, and this is the exact type of environment I'm speaking about when I initially had a multi-year hold plan ahead of me for that position, but then all these investors coming in shrunk down the average time horizon, which ended up resulting resulting in the company's stock plummeting down quite rapidly after a large pump. Now, in this specific example, I'm not saying that the company in question and this industry does not have massive potential. It's actually quite the opposite. I'm just speaking from an actual stock valuation standpoint. This is a type of euphoric environment that results in many investors holding the bag on that position when it ends up crashing down. I'm just saying that with this type of stock, if you do end up planning on holding it rather than flipping it quickly in the short term, we'll do expect high amounts of volatility. The second element that I look for is the company's intended direction, as well as upcoming projects and financials, and then from this, my overall take and future convictions about this company moving forward. Again, I shouldn't have to mention that you should only invest in companies that fit within your overall risk tolerance, as well as fit in your broader portfolio and asset allocation after conducting proper research on these companies. And this is accomplished through revisiting the company's financials as well as business highlights, at least on a quarterly basis. This should be a minimum practice for you if you're a longer term investor in a company. And look, I'm not recommending that you spend hours on each company revising all of the financial statements each quarter for the companies that you own, but even just a quick glance over the financial highlights as well as business highlights for the quarter are going to keep you up to date with what that company is doing, and this should be something that you're interested in since you're holding stock in that specific organization. But really what this allows you to do though is re-audit each position in your portfolio, and then at current price point in the time being, determine whether or not you're comfortable holding onto the stock, or maybe you want to add more to the stock or trim that position based on up-to-date financials and business highlights for that company. In current market environments, things are so volatile that it's really okay for you to change your thesis in contrast to what you had initially planned out for that position in your portfolio. For example, Afria, ticker symbol AFA on the TSX, is a stock that I did really well with over the past year. When I started buying shares, they were in the $3 range, and at the time, at least based on publicly available information, Afria was producing cannabis at a higher gross profit margin, and a couple other elements were really what attracted me to this stock at those price points. But I was expecting the stock to reach the maybe $10 range within a year minimum target. So when the stock initially drove up to the $16, $17 range in a really rapid time frame, I sold off a portion of my shares to cover my initial cost basis because I found the price to be slightly out of line with my projections, and that's okay. Of course, I could have continued holding on to the shares, but there's nothing wrong, in my opinion, with taking some profits if a company does end up doing better than you had anticipated and considering a change in the playing field. And this actually leads me into the third element, in that when one or a handful of your positions end up performing really well in the market, typically what ends up happening is that the asset allocation, or the weight I should say, for those positions will greatly outweigh the rest of your portfolio, meaning that the performance of those positions moving forward will have a much larger impact on the variation of your portfolio's value, right? So again, with Afria, having that position exceed a 400% return on investment at the time, well, what ended up happening is that Afria represented probably around over 20% of my portfolio's entire value at the time. And that was also one of the reasons why I chose to trim off some of that position. It really depends on the company in question and my convictions towards that company's future growth, as well as the growth of the industry it operates in. But I typically tend to keep each one of my positions at less than 15% of my overall portfolio. And that is where the concept of rebalancing a portfolio comes into play, in that over time, as you hold certain companies and they perform in the market, well, the weights associated to each one are going to fluctuate greatly in the overall portfolio. There are definitely different schools of thought here in regards to trimming off positions that have performed really well, but at the end of the day, you really just need to ask yourself, well, am I comfortable holding one position that represents maybe 30-40% of my entire portfolio's weight? That is something that you're going to have to decide as an investor for yourself. If you have crazy conviction in the company's future growth and success, then maybe this will make sense based on your risk profile. But do just remember here that trimming off some of your winning positions, I'm not saying selling off the entirety, but trimming off pieces does allow you to actually materialize some profits and then also reinvest some of those profits into other positions that you deem as being great potential stocks to add to your portfolio for future growth also. And then finally, the fourth element that I take into consideration, this is more of a technical indicator for shorter term investing, or at least for when you could look to dollar cost average buying the dip on companies that you are comfortable holding and buying more of long term. It is called the RSI, and this is an acronym for the Relative Strength Index, which is a momentum oscillator that measures the speed of price movements that can tell you if the stock or position is being overbought or oversold in the market. Now, even though this is typically used for shorter term investing and trends in market price, I still use it to determine on, a shorter term time frame when an opportune time to buy in would be, because typically when a security enters overbought territory, this is followed by a slight pullback and vice versa, without getting too in depth about this concept. In this example, we're looking at the RSI for Teladoc over the past couple of months, where we can see that when it initially shot up in value to about the 200 range, it had entered overbought territory, and this was followed with a sell-off of this market price. So if you do end up looking at the RSI for most stocks, this is typically the case where when it does enter overbought territory, it is followed with a slight correction. And this tool can be used to help you better deploy cash for dollar cost averaging on the dips, and then on the flip side, sell or trim your position when it's entering oversold territory if you feel like doing so. Hey, at this point in the video, if you're enjoying the content, make sure to drop a like. It really helps my channel out, and also consider subscribing if you haven't already. Alright, so now that we've had the chance to speak about some of the things I look for in a winning stock before trimming that position, let's now speak about elements that I consider when a stock has actually gone south and you're considering cutting your losses on that given stock. Let me be clear though that even though this is quite evident, actually selling a position at a loss will materialize what might have been previously a paper loss on that one position. This would also mean that you do not have conviction in the company's future success based on your most up-to-date analysis of the company, and so for this reason you will not be bolstering your position or buying more during this period of time when the stock is down. Since I only buy companies that I have done extensive research on and really believe in their longer term success and growth, well, typically speaking, a correction on the stock's market price I see as a buying opportunity, because at the end of the day, it's the exact same company, it's just that the market price has fluctuated, making this a time to dollar cost average and buy the dip. A really easy exercise that you can do when you're auditing the positions in your portfolio, I personally do this myself, is ask yourself, well, at the current price point for that given stock or ETF, would I buy more considering the lower market price? If the answer is yes, then you should most likely be buying more or just holding on to that position. If the answer is no, well, you should most likely consider cutting out that position of your portfolio, because theoretically speaking, at a lower market price point, this should be a time when you're looking to capitalize on this opportunity to buy more for longer term growth of that position. Right? So considering this on the positions I hold in my portfolio, because I have typically a multi-year hold investment horizon for those companies, when I see the stocks dipping in market value, I get excited because this is a time when I'm looking to buy more. For example, Trulieve Cannabis is a company I've spoken about a lot recently on the channel, and I'm extremely bullish on this company's growth longer term. So considering the fact that it's dipping down to the $50 range, I see this as once again an opportunity to buy more, even though my position is now in the red. And this is in contrast to my previous position that I held in Real Matters a couple of months back. I sold off after the stock continued to decline in value for a couple of months from my initial buy price, since my convictions on the company's business model changed in correlation with the investment horizon. So yeah, I decided to sell and I don't regret it. All of this does require though that you do stay up to date with each one of your positions, hence the reason why it's important to re-audit each position on around a quarterly basis. In fact, Peter Lynch, former Fidelity manager and author of Beating the Street, advises against a buy and forget strategy in regards to individual stocks, regardless of the quality of the company. And he recommends that investors perform a 6-month portfolio checkup to determine if the stock is getting better, worse, or unchanged. And if the stock and company is performing worse, he recommends decreasing the weight allocated for that one investment. He also recommends that you cut your losses quickly rather than dwelling on a stock performing poorly for months or even years, just hoping that the stock ends up recovering based on no concrete evidence or real factual data. I would even argue that trying to take corrective action rather quickly is essential in longer term investment success, because it is inevitable that you're going to have winning and losing positions in your portfolio over the years that you're an investor. So before letting your losses grow larger and larger and just holding on, cutting your losses a bit quicker can be a good strategy to minimize your downside risk. Also keep in mind that with this liquid cash that you're now regaining back from selling off that losing position, well, you can reinvest that capital back into another stock or another exchange traded fund that you see showing greater potential than just holding on to that losing stock and hoping that it's going to go back up in market value, at least up to par with what you purchased it for. Basically, the opportunity cost that you're losing out on with that capital is actually going to be far greater than just the money that you're losing out on that bleeding position. And finally, I would say that cutting your losses on a bleeding position might be the right decision if this is causing you mental agony and stress. Like honestly, investing is very much a game of mental resilience, and if you find yourself constantly checking your brokerage account because most of your portfolio is comprised of high-risk penny stocks, then not only should you consider selling, but also take the time to reassess your strategy and how you're going to be approaching portfolio construction moving forward. All in all, the moral to take out of this is that there isn't really a clear blueprint for every position as to when the best and opportune time to sell off a portion of that stock is going to be. Every scenario is going to have to take into consideration various different elements, at least in terms of longer term investing. With day trading, well, it's a completely different story, but I'm assuming that most of the viewers watching this right now and on my channel are longer term investors looking to grow their wealth in the stock market over a longer period of time. So that pretty much wraps up today's video, covering some various different elements to consider about when you should look at selling a stock, either a winning position and or a stock that you want to cut your losses on. I really hope this provided some value to you. If it did, make sure to smash the like button. It really helps the channel out. Also, make sure to check out the links down in the description to resources I use and recommend to new and intermediate investors, and subscribe to the channel and hit the bell button to be notified of new and upcoming content. I also want to mention that I've started posting on TikTok, so if you want to follow me on there, make sure to follow me. It's just at Griffin Milk. So with that said, thanks for watching today's video, and I will see you in the next one.